Good morning and welcome to today's webcast, Tax Credits and Incentives Update for Healthcare. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
I'm pleased to introduce today's presenters from Moss Adams, Kyle Sund, Senior Manager in our consulting group based out of our Portland office, and MaryCaitlin Willcuts, Manager in our State and Local Tax Services Group, also based out of our Portland office. And with that, I will turn it over to Kyle to get us started.
Thanks, Emily, for the introduction. Welcome everyone to this webcast, which we hope will give you a great perspective on tax credits and incentives for healthcare companies. We're going to start our discussion talking about the tangible property regulations, which were effective for tax years beginning on or after January 1st, 2014. The regulations help provide taxpayers a framework to analyze whether costs incurred to existing tangible property should be treated as a depreciable capital improvement or potentially a deductible repair expense. Taxpayers who file accounting method changes, otherwise known as Form 3115s, are not able to file another accounting method change related to TPR for 5 years. Since many taxpayers filed these 3115s for the 2014 tax year to just simply comply with the regulations, the 2019 tax year is a new window of opportunity. Many real estate owners miss savings opportunities related to deductible repairs that have been treated as depreciable capital improvements on previous tax returns. Performing a review of your existing asset holdings can reveal associated improvement projects from prior tax years that could have been classified and expensed as repairs. And especially, greater internal scrutiny should be applied for businesses that own real estate or leasehold improvements, and that obviously includes healthcare facilities. An issue that we encounter frequently is where taxpayers have treated the cost of tax-deductible repair and maintenance expenditures as depreciable fixed assets. Often, they're depreciating the cost of these activities over 27.5 or 39 years, rather than claiming the full deductions they're entitled to take in the year paid, and that's according to the tangible property regulations. We refer to this as the overcapitalized repair issue. We often identify this issue for companies that have numerous real estate fixed asset holdings. Buildings constantly require upkeep and maintenance, plus building owners just generally perform elective projects or remodels based on the underlying business needs of their company. So with all of these activities associated with real estate, it can become increasingly challenging to apply the guidance from the regulations. The regulations guide us to consider several quantitative and qualitative factors of the current activity done to a building, as well as the impact to specific building structure or system components. So for example, a $5,000 cost to replace, let's say, one of 2 water heaters in a medical office building, it may actually be required to be capitalized due to it being a critical part of the overall plumbing system of the building. On the flip side, a $500,000 cost to replace the roof coverings on the same building may be an expense, and just depending on the factors. So a repair study is a great solution for identifying overcapitalized repair issues for your company. Some of the things to look out for are just generalized phrases such as building improvements, almost like a catch-all category on the depreciation schedule, or maybe specific areas where work is done. So, in this case, lobbies, waiting rooms, hallways, things that are easily identifiable. And then specific building systems, maybe it just says HVAC work or plumbing, roof. Those are good things to dig into as well. And sometimes it's just simply costs that end up on the depreciation schedule that had certain phrases like repair, refurbish, maintenance, cleaning, etc. So you can do this in real time on current year tax filings, but in order to take advantage of prior year overcapitalized repairs, you'd have to file a Form 3115 accounting method change to catch up the adjustment. All right, so here's an example. Let's assume a hospital building that was constructed in the year 2000 for $50 million. As you can see on the depreciation schedule, there were some costs capitalized as building improvements in 2005. Then there were some lobby and hallway remodels from 2007 to 2009, and then an HVAC project and some roofing work done in 2012. In the far right column, you can see that there's still quite a bit of net tax value left on these assets that were capitalized a few years after the original construction of the building. So let's say you had a repair study completed and you had someone dig further into the detail for these specific projects. So you found that the first building improvement project just involved some paint and exterior refreshes. And then the other building improvement project from 2005 was just manufacturer recommended maintenance on rooftop HVAC units, even though, on the depreciation schedule, there was no identification that the building improvement project was even HVAC related. And then the lobby and hallway remodels, maybe they were just general refreshes of finishes and lighting. The HVAC project in 2012, let's say it was just 2 of 10 rooftop units that were replaced. The tangible property regulations actually have specific examples related to this that points to this as a potential repair. And then the roof replacement, if it only involves a roof membrane, there's also a lot of specific examples in the regulations, and this could potentially be a repair as well. So if the documentation is accurate and the findings are correct, it's possible that assets 3 through 9 on the depreciation schedule could be expensed as repairs. And in this case, ABC Hospital would file a Form 3115 on its 2019 tax return to claim the $2.2 million deduction. So the value of looking at overcapitalized repairs includes a couple of items. First, it creates a balance between available tax deductions and capitalized fixed assets, and then utilizing those tax deductions to offset taxable income. Second, it creates more efficient processes for identifying overcapitalized repairs while also applying consistent CapEx policies on a go-forward basis for the company. And third, tax reform eliminated certain improvement property classifications, plus it mandated the use of longer recovery periods for real property if elections are made to circumvent interest expense limitations. So just generally speaking, it's become increasingly important to identify deductible expenditures. The bottom line is that many taxpayers filed 3115s to simply comply with the regulations on their 2014 tax returns. So now the 2019 tax year is a new opportunity to look at these historic overcapitalized repairs. And now is a great time to just generally do a 5-year check-in to see how your company's compliance is going. So now we'll discuss a similar incentive related to fixed assets. So many taxpayers dedicate a tremendous amount of resources to manage their fixed assets, but they often find that their books aren't organized or they're just in general disorder, and maybe some of the assets aren't even being properly classified. So this can not only be a compliance risk, but it also leads to a lot of missed tax advantages and potentially reduced cash flow. So a review of depreciation schedules is designed to reduce federal and state tax liabilities by applying tax laws to a company's fixed assets. So we have standard depreciation lies in Rev Proc 8756. That's where you generally have, the 5, 7, 15-year categories. Taxpayers miss those, but they often also miss other beneficial accelerated depreciation methods and lives, including qualified property. So, in the case of this webcast, with qualified leasehold improvement property or qualified improvement property would be the two most common. We also see a lot of taxpayers that miss just provisions such as bonus depreciation or maybe asset retirements, ghost assets, which we'll talk about in a little bit. The beauty of fixed asset studies is that the results can be applied to a current year or future tax returns through an automatic accounting method change. But the benefit compared to the tangible property regulations is that there's no 5-year waiting period. So we can do this on 1 year just as long as we can do it on 1 year, and then we can do it on the following year just as long as it doesn't involve the same exact assets. Fixed asset studies are most useful for healthcare or senior housing companies, generally speaking, with $25 million or more in fixed assets, and also those that self-manage their fixed assets from numerous decentralized locations. When multiple locations or people are involved, the consistency across the company's entire fixed asset schedule can be sometimes inconsistent from a tax perspective. So less than allowable depreciation would be when taxpayers miss beneficial accelerated depreciation methods and lives. So as I mentioned, bonus depreciation or maybe even Section 179 expensing. And in some cases, too, they'll miss qualified property. So as I mentioned, qualified leasehold improvement property or qualified improvement property specifically for healthcare buildings. And often taxpayers just simply classify the assets with incorrect recovery periods. So a couple of examples that we've seen, a medical office building could have taken qualified improvement property on interior non-structural improvements, and since qualified improvement property was eligible for bonus in 2016 and 2017, that resulted in a huge adjustment. And a senior housing owner had assets buried in just general improvement projects that could have been segregated out into shorter recovery periods that were also eligible for bonus depreciation. And lastly, a hospital that invests a significant amount of dollars into medical equipment, just those equipment amounts ended up on the depreciation schedule as 39-year building property. And instead, they obviously should have been 5-year life, or a 5-year life, which was obviously, again, eligible for bonus depreciation. So ghost assets are another category that we look for in fixed asset studies. These are assets that just flat out do not physically exist anymore because they've been physically removed from the building or property due to other work being completed. A couple of examples, again, on this would be a medical office building. Let's say it was acquired in 1980, and it had all the rooftop HVAC units replaced in both 1995 and again in 2015. The taxpayer could claim a loss for the 1995 rooftop units because they physically don't exist on the property anymore, and they're considered a ghost asset. A second example would be a senior housing facility that was acquired in 1995. The facility has multiple floor-to-ceiling remodels completed in 2000, 2008, and 2015. And so in this case, assuming the taxpayer could prove that all assets in the 2000 and 2008 remodels were physically removed, the taxpayer could claim a loss for these ghost assets. Now we're going to get into our first polling question.
All right, our first polling question today. Your company has had a repair study completed to conform with the Tangible Property Regulations, TPRs, and or a fixed asset study with a comprehensive review of your company's fixed assets. A, repair study only. B, fixed asset study only. C, both repair and fixed asset studies, or D, neither. I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit submit. Just a couple more seconds here. And let's go ahead and take a look at the results. Kyle, back to you.
Yeah, thanks, Emily. So, yeah, it's interesting to see and just trying to get a perspective on, what companies are doing kind of out there in industry and trying to get a feel for who's doing what. So I think these are interesting numbers to see. So the next topic we'll talk about is bonus depreciation, which saw some significant changes in the Tax Cuts and Jobs Act that was signed into law in late 2017. So the change to bonus depreciation was retroactive to qualified property placed in service after September 27, 2017. The bonus percentage not only increased from 50 to 100%, but the property eligible for bonus depreciation was expanded now to include used property. But it only applies to used property if that property was actually acquired through an arm's length transaction. This can be especially useful for properties that have cost segregation studies completed on the acquired property or the used property. I'll talk about cost segregation studies in a few slides. So the bonus percentage phases down by 20% per year starting in 2023 and is completely phased out by 2027. Another aspect to consider, since bonus depreciation was increased from 50 to 100%, is the place in service date. So specifically, in order to qualify for 100% bonus, a written binding contract for the acquisition of the property cannot be in place prior to September 28, 2017. If there was a written binding contract prior to that date, the property would only be eligible for the pre-tax reform bonus percentages, and that's regardless of when it's actually placed in service. So for instance, if you had a written binding contract to acquire an asset eligible for bonus depreciation prior to September 28, 2017, but you don't actually place that asset in service until 2019, then you would default to the pre-tax reform bonus percentage of 30%, which is what it was in 2019. So even though you place the asset in service in 2019, it's not a slam dunk that it's going to be 100% bonus. So now, as I mentioned, we're going to get into cost segregation studies. So cost segregation studies are used to identify assets in a building that might qualify for shorter tax depreciation lives. So they identify property that can be depreciated over 5, 7, or 15 years rather than the standard 27.5 years for residential rental property or 39 years for non-residential real property. So as it relates to healthcare, 27.5-year property would include senior housing facilities, and 39-year property would include hospitals, skilled nursing facilities, medical office buildings, and surgery centers, among others. Cost segregation studies can be done not only for acquisitions and newly constructed buildings, but they're also great for tenant improvement projects, remodels, expansions, etc. The way to think about cost segregation is this. Assume that you have $100,000 of assets that were potentially eligible for shorter lives. Would you rather take the majority of the $100,000 deduction in the first few years of ownership, or would you rather take that $100,000 deduction spread out over 27.5 or 39 years? So assuming taxpayers can actually utilize those deductions, the deductions are worth more today than they are in the future, just simply because of the time value of money. So as I mentioned, there's quite a few types of cost segregation studies. Basically any sort of construction project, so ground up construction, remodels, expansions, tenant improvements, plus acquisitions, as I mentioned. Any of those can make sense to have a study completed. And if a property was acquired through a 1031 exchange, a cost segregation study might be beneficial if the new depreciable basis is high enough to actually justify having a study completed. These studies can be completed on a look-back basis, again through an automatic accounting method change, Form 3115, which I've now mentioned a few times in this webcast, which is going to be a common theme. A taxpayer would catch up the depreciation missed on prior tax returns by taking those deductions in the year that the 3115 is filed, and this can be done, again, without amending any prior year tax returns. So why do taxpayers want this done? Just simply put, it's increased cash flow. It allows taxpayers to recapture depreciation deductions sooner, which can then be reinvested elsewhere. Or if a taxpayer is in a loss position but expected to be taxable soon, so for instance, maybe they have expiring credits or used up carry forward losses, it might make sense to have a cost segregation study completed. And of course, it also depends on what the taxpayer's current and future goals are. So typically for ground up new construction projects, or acquired properties, a good low-end threshold is about $1 million to make a study pencil out. And for interior improvement projects, that low-end threshold is closer to $250,000. And because of the time value of money and depreciation recapture, taxpayers who hold onto the property for more than 5 years would benefit more than if they only held the property for 2 or 3 years, although that can definitely vary by taxpayer. So as an example, for a $1 million senior housing facility, there could be anywhere from 20% to 35% of the property allocated to shorter depreciable lives. So that would mean $200,000 to $350,000 of accelerated depreciation. And for hospitals, skilled nursing facilities, medical office buildings, and surgery centers, the percentages are a little bit of a wider range, between 20 and 50% of the total cost into shorter depreciable lives. The purpose of this graph is to show how accelerated deductions would be taken in the first few years of ownership versus spread out over a much longer period of time. So the blue line shows the accelerated deductions taken earlier on, but the later years would yield slightly less depreciation deductions when compared with the regular straight line depreciation, the gray line. But the key here is that you're front-loading the depreciation deductions in the early years of ownership rather than waiting for those same deductions over a much longer period of time. Let's get into an example. So assume a senior housing facility that was purchased in June of 2019 with a total depreciable basis of $10 million. As I mentioned earlier, the depreciable life for a senior housing facility, which would be independent living, assisted living, and or memory care, that depreciable life for the building is 27.5 years. The green column reflects the total annual deductions without the cost segregation study. And that's just if the owner was just able to use the straight line depreciation, as I had mentioned on the previous graph with the previous slide. And the blue column reflects the total annual deductions with the cost segregation study. So that's where assets are getting carved out into 5, 7, or 15-year lives. In the far right section of the chart, highlighted in yellow, that reflects the increase in deductions. So it's just the difference between the blue and the green columns on an annual basis. Because the taxpayer would be able to utilize 100% bonus depreciation on the 5, 7, and 15-year assets, the entire cost of those categories are getting fully depreciated in the first tax year, 2019 in this example. So therefore, the total additional deductions in 2019 would be a little over $3 million. And using the federal and state tax rates, the overall net present value of the study would be approximately $678,000, which is in the orange box in the bottom right corner. So now we're going to head into our second polling question.
All right, our next poll, cost segregation studies can be completed for which type of property? And your options are A, a for-profit hospital, B, senior housing facility, C, medical office building, D, surgery center, or E, all of the above. And as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. I'll give everyone a couple more seconds here. And let's go ahead and take a look at the results. Kyle, back to you.
So it looks like everybody got this one right, which is E, all of the above, and that's great because, yeah, like I said, they apply to so many different types of buildings, and including in the healthcare space. So something that you definitely want to look at taking advantage of. Now we're going to talk about the energy efficient building deduction, otherwise known as Section 179D. So in December of 2019, President Trump signed an extenders tax package into law, and that extended a number of provisions that had previously expired at the end of 2017. MaryCaitlin is going to be talking about a few of these provisions on some upcoming slides. The one we're going to talk about here is the Section 179D energy efficient commercial building deduction. And it's available now for newly constructed buildings or building improvements that are placed in service through 2020. So this deduction is available for improvements now in a 15-year window. So going all the way back to January 1st, 2006, all the way through now to December 31st, 2020. These can also be done, again, as I mentioned before, the common theme They can also be done on a look-back basis through an automatic accounting method change, Form 3115. So both building owners and designers can claim the deduction. More specifically, these categories include the owners and tenants of commercial properties, but only if they've built or installed the improvements. And specifically for the purposes of this webcast, commercial buildings would include hospitals, skilled nursing facilities, medical office buildings, and surgery centers. And then residential buildings would qualify if they're 4 stories or taller. So in this case, for senior housing facilities, they would qualify, but again, they have to be 4 stories or greater. So the deduction can be as much as $1.80 per square foot for commercial building efficiency improvements above certain thresholds for 3 distinct categories, and each of these categories receives 60 cents per square foot. So it's HVAC systems, interior lighting projects, and building envelopes. All these have to be, part of new construction or remodel projects. So let's say you owned a 100,000 square foot building and you qualify for all 3 deductions. So your total Section 179D deduction would be $180,000, so pretty simple math. Taxpayers can also claim deductions for just 1 or 2 of the per square foot deductions, so that's depending on the type of work completed. So for instance, if you had just an interior lighting retrofit project only, you could receive 60 cents per square foot just for that project alone. And a contractor or professional engineer licensed in the state where the building is located must model the energy performance of the building and compare it to standards set by ASHRAE. So a common misconception that we see is that people just generally think that LEED certification, the energy efficient kind of standards that a lot of people see, a lot of people think that the LEED certification automatically means that you'll be able to take the full $1.80 per square foot deduction. So although it's helpful to determine likelihood of the qualification, the energy modeling project is still a requirement. So a couple of key takeaways. So both overcapitalized repairs and fixed asset studies can be utilized by healthcare companies to provide substantial benefits to reduce current tax liability. Bonus depreciation is now at 100%, and it also applies to used property. So it can be especially powerful when utilized with a cost segregation study. And the Section 179D energy efficient building deduction was extended through the end of 2020. And so we now have a full 15-year window to look for these opportunities. And now I'm going to pass it off to MaryCaitlin to continue with her portion of the webcast.
Great, thank you, Kyle. Okay, so now we're going to go through a handful of federal wage-based incentives. Each of these are, really great and valuable opportunities for businesses in the for-profit healthcare industry. So the first one we're going to discuss is the Federal Disaster Retention Credit. So legislation for this credit was recently retroactively extended as part of the spending bill signed into law on December 20th. This is an incentive to employers for retaining and paying employees whose physical location of employment was impacted by a qualifying natural disaster during 2018 or 2019 and is located within a federally declared disaster area. So something to note, is that currently businesses will need to amend their 2018 return to take the credit for eligible wages from a 2018 disaster. However, the IRS is discussing possibly issuing guidance to allow businesses to claim the 2018 credit on their 2019 return. So there's more to come on that. These types of credits have been around for a long time, dating back to at least 2005 with Hurricane Katrina. Typically, this type of credit, typically this type of legislation includes a couple disasters. So for example, in 2017, it only allowed for the California wildfires and hurricanes Harvey, Irma, and Maria. But with this new legislation, it's really opening it up and allowing businesses who are infected by various disasters to potentially qualify. So to qualify, an employer must have locations within a qualified disaster area that became inoperable as a result of damage sustained from a qualifying disaster. So inoperable is actually an undefined term, and we'll discuss a little bit more on the next slide on what inoperable could mean. And for qualified employees, those are individuals whose primary place of employment, so the place they perform the majority of their work, was impacted and the employer retained and continues to pay them wages. So for example, this could be an employee that maybe was moved to a different location so that they could continue working, or possibly they couldn't work at all, but the employer continued to pay them. The eligible period for this credit begins the day the location was impacted up until the business has resumed significant operations. So as I mentioned, inoperable is an undefined term. However, here are some examples of situations that had qualified in prior years as reasons a business became inoperable. So for example, the physical location was damaged and it's uninhabitable. This could be structural damage, smoke or water damage, unsafe air quality, no utilities, things along those lines. Also, the location could have been inaccessible, due to the roads are closed, or maybe even, there was a mandatory evacuation. It is important, so this is really, really important, that businesses use a reasonable and good faith interpretation in determining if their business interruption qualifies. Also, the same goes for when determining when significant operations has been resumed. So, being a federal income tax credit, it's also a general business credit with a 1-year carryback and 20-year carry forward. The credit is wage-based and provides for a credit up to $2,400, which basically is 40% of the first $6,000 in wages paid to a qualified employee. And eligible wages are those paid from the date of impact to when significant operations has resumed. On the right-hand side, we have a sample calculation. So this is looking at a full-time employee who makes $15 an hour and worked at a qualified location that was closed for 9 weeks. So you can kind of see what the estimated credit could be in this situation. And then below that is looking at an employer that has 75 employees at one location. Kind of using the same facts, and kind of what that cumulative credit could potentially be. So it can be pretty significant. So we wanted to give you kind of a visual to show you really how impactful this credit can be for 2018 and 2019. So here's a map we put together. It shows the different counties in each state that are considered qualified disaster areas for purposes of this credit. And this map includes both 2018 and 2019 eligible areas. So as you can see, this is really significant. There are a number of eligible areas all over the United States. And to determine if you have a business location that's in a qualified area, we are always happy to do complimentary scrubs of your business location. Or you can also go to the FEMA website and search by major disaster declaration, and then you can filter by state. Okay, now we've reached another polling question.
Okay, our third poll. Did your company have locations impacted by a natural disaster in 2018 or 2019? And your options are A, yes, but did not disrupt a business. B, significant damage. C, no. D, not sure. And for those of you that would like a copy of today's slide deck, you can download them now from the folder that says slide deck and handouts to the right of the slide view. We will also be sending the slides via email after the webcast. And we'll give everyone a few more seconds here. And let's go ahead and take a look at the results. MaryCaitlin, back to you.
All right. So quite an interesting answer. We really wanted to kind of get an idea of, how many people out there may have potentially had a situation where they could benefit from this credit. All right. So now we're going to discuss the Work Opportunity Tax Credit Program, also referred to as WOTC. This program has been around for many years, going back to about 1979. It's existed in various forms, including the Ticket to Work program, until it was enacted in 1996 as part of welfare reform and effectively called the Work Opportunity Tax Credit Program. Just a little note, since 1996, the WOTC program has helped over 28 million individuals transition from public assistance into the workforce. So this too was recently extended through 2020 as part of the spending bill. And essentially what this program is, it's an incentive for employers to hire individuals at a disadvantage to employment. So typically this means someone who is struggling to find employment and is on and maybe on government assistance to supplement their income. So on your screen, below are all of the current available target groups that new hires can qualify under. So for example, food stamp recipients, those unemployed and receiving unemployment compensation, TANF, which is temporary aid for needy families. So depending on the target group, the maximum credit amount can range from $2,400 to $9,600 per qualified employee. And you'll see on your screen there are 3 target groups with green stars. These are the most common target groups that we see employees qualifying under in the healthcare industry. So in general, this credit targets for-profit employers. However, there is the ability for 501c employers to take advantage of a portion of the credit. So back in 2011, as part of the Vow to Hire Heroes Act, new legislation was passed to allow 501c employers to take the credit for hiring qualified veterans, and the credit that is generated can be used to offset Social Security tax. So on your screen, the table to the far right, veteran target groups, these are the eligible groups for 501c businesses. And the maximum eligible credit is actually calculated at a little bit lower rate. So the maximum amount of credit available ranges from $1,560 to $6,240 per qualified employee. So this is a prospective program. It requires employers to screen new hires for the credit to determine if they qualify under a target group. So only brand new hires with a company may be eligible. Anyone who has previously worked for the employer, regardless of how long ago, are ineligible. And while this is a federal program, it's actually administered at the state level with state WOTC coordinators. And applications for qualified new hires must be filed with those state WOTC coordinators within a statutory 28-day window in order to obtain a certification. And there is no limit to the number of certified new hires an employer can claim the credit for. However, it is just a one-time credit per qualified and certified new hire. The percent the credit is calculated is based on the gross hours a certified new hire works within their first 12 months of employment, or 24 months for long-term TANF. Below shows you how the percent is determined based on their gross hours. So one thing to note, a new hire must work at least 120 hours in order for their wages to be eligible for the credit. If they work between 120 to 399 hours, the credit is 25% up to the wage cap for the target group. And if they work 400 or more hours, the credit is 40% up to the wage cap for the target group. This can be a very beneficial credit for businesses in the healthcare industry. For example, below are models using data points from 3 different size companies, and size is being determined based on employee headcount. So different companies that we currently work with and the types of benefits they are generating. So this is to kind of give you some perspective. So depending on the employee headcount of your company, this could be very impactful, especially if you're not currently taking advantage of it. So the best way to take advantage of this program is to outsource it. There are many limitations to a company trying to do this in-house. So below shows you kind of the benefit of outsourcing this, but please note, these examples here are purely based on, what we do here at Moss Adams and is not representative of what all other WOTC providers may or may not do. But on the left, you can see, the minimal steps an employer is asked to do when they outsource this. So first, provide access for a new hire to be screened for the credit. Generally, this is all done electronically. And second, since this is a wage-based credit, employers need to provide payroll to their outside provider in order to allow them to calculate the credit. And then on the right, you can see what the provider does on behalf of the employer and some of the administrative responsibilities that go into this program. This is just a highlight of some of these steps. There are definitely a lot more that go into this. But most importantly, providers have established relationships with WOTC coordinators, and they're up to date on the filing, follow-up, and appeal processes with each coordinator in order to obtain certifications for the employer. And when this is done in-house, typically this work is leveraged to an HR representative. So there is a big value to hiring a provider in order to take care of administrative steps and allowing HR representatives to focus their time and energy on the business and their primary job responsibilities. Okay, so we've reached another polling question, which I believe this is our last.
Yep, our final polling question. Is your company currently taking advantage of the WOTC? And your options are A, yes, B, no, C, no, but we would like to, or D, not sure. I'll give everyone some time on this final poll. Once you have completed all CPE requirements, you will be able to download a PDF of your CPE certificate from the CPE progress window to the right of the slide view. And let's go ahead and take a look at the results. Back to you.
All right, so it looks like many people on the call are not taking advantage of the program, and many of you aren't sure. But for those of you who are, that's great. I'm glad to hear that. And those of you who are not, I definitely recommend, looking into it for your company. All right, so next we're going to look at the employer paid family and medical leave credit. So this was a new credit that came out in 2018. It was also recently extended through 2020 as part of the spending bill. This is an incentive for employers who provide a voluntary paid family and medical leave plan as part of their benefit package. And so this is separate and distinct from state-mandated paid leave programs. A couple of examples of what qualifies an employer is that they need to provide a voluntary paid family medical leave benefit, allowing at least 2 weeks paid leave, so this is not including PTO or sick time, and at a rate of at least 50%. The credit, again, is wage-based, and the percent the credit is calculated on is based on the percent of leave wages paid by the employer. So eligible wages are those paid to a qualified employee during the first 12 weeks of leave, and the calculation percent starts at 12.5% and increases by 0.25% for every 1% increase in wages paid, up to 25%. So as you can see in the table to the right, an employer who provides paid leave at a rate of 50% is allowed a 12.5% credit. Or, an employer who provides paid leave at a rate of 100% is allowed a 25% credit. There is a wage cap for qualified employees. So for 2019, qualified employees cannot earn more than $72,000, and for 2020, qualified employees cannot earn more than $75,000. So, again, like the others, federal income tax credit, general business credit. On the right-hand side, we have a sample calculation. So this is looking at a full-time employee who makes $65,000 a year, took 12 weeks of qualified paid leave, and was paid 70% of their annual salary during their leave. So that kind of gives you an idea of potential eligible credit. And then below that is an example when an employer has 50 employees, qualified employees, with the same facts and, kind of breaking it down and showing you what the cumulative credit could be. It is important to know that employers in states with mandatory paid leave laws are less likely to qualify. And currently, states with these laws include California, New Hampshire, New Jersey, New York, and Washington State as of January 1, 2020. There are two more federal wage-based incentives that we want to briefly discuss. The first being the Federal Empowerment Zone Credit. This was retroactively extended from January 1, 2018 through December 31, 2020, again, as part of the spending bill. It's an incentive for employers to hire individuals who both work and live in a federal empowerment zone. Currently, there are zones in 26 states. Each zone varies significantly in size. Some covering a few acres, while others almost the size of an entire city. There are no pre-screening or applications required for this program. And the credit is equal to 20% of eligible wages up to $15,000, resulting in a $3,000 credit annually per qualified employee. So an employer can take the credit each year the employee continues to live and work in the same zone. The last credit is the Indian Employment Credit. It too was retroactively extended from January 1, 2018 through December 31, 2020. It's an incentive for employers to hire individuals who are enrolled members of an Indian tribe or spouses of enrolled members, and who work on a reservation and live on or near the same reservation. Gaming facilities are, I think, one of the only that are ineligible for this credit. There is a wage cap for qualified employees. They cannot earn more than $30,000 annually. And there are no pre-screening or applications required with this program either. The credit is equal to 20% of eligible wages up to $20,000, resulting in a $4,000 credit annually per qualified employee. And lastly, eligible wages include wages for services performed, but it also allows for qualified health insurance costs. A note about all of the credits that we've talked about, since they are all considered general business credits and are wage-based, it's important for employers to consider each of the credits they are taking per employee, as they cannot use the same wages for the same employee on more than one incentive. So for example, if an employer is taking the WOTC on an employee who is also eligible for the disaster credit, employers need to consider the eligible wages for each calculation to ensure they are not using the same wages for both credits. So typically the employer would first use the wages for the WOTC, and the remaining wages would be eligible for the disaster credit. So this also applies to a portion of the federal R&D credit as well. So I just wanted to point that out. All right, so that is the end of our presentation. So now I think we will move over and answer any questions that we might have if we have extra time.
All right. If you have a question for Kyle or MaryCaitlin, you may submit that now in the Q&A window right beneath the slide view. We do have a couple of questions. Let's see, it looks like our first one here, I have heard there is a WOTC target group for the Federal Empowerment Zone. Does that target group apply now that the Federal Empowerment Zone credit has been extended?
Yes, that's a good question. Yes, so now that the empowerment zone has been retroactively extended, the target group that encompasses empowerment zones as well as renewal communities, both are eligible. So if your business is in an empowerment zone and you're hiring employees that are living in that same zone, you will automatically, they will automatically qualify for that target group.
All right, thank you. Let's see, for the WOTC, what happens if an employee goes on a leave of absence and returns back within their first year?
So that's a good question. So with purposes of the WOTC program, if an employee goes, if they qualify and within their first 12 months, they go on a leave of absence and have not been determined as terminated in their system, then if they come back from leave within that first year, the cumulative amount of wages that they earned from the first portion up until when they are, and after they've returned, all of that can be used for the credit. However, if they return after their 12 months, their first 12 months, then only the amount of wages that they earned at the beginning would be eligible. But if they were at all terminated in the system, then they would no longer be eligible.
Thank you. Looks like we have a couple more. As a healthcare organization, an organization exempt from federal tax purpose, how can we claim employer-paid family and medical leave credit?
Good question. Unfortunately, you cannot. So if you are an exempt organization, the only program that we talked about that you could take advantage of would be the WOTC piece for the qualified veterans. The other programs do not apply to exempt organizations.
Great, thank you. Looks like we have a couple more questions coming in. Does disaster credit work for 501c3 organizations?
Again, yeah, unfortunately, no.
All right. The only tax credit that not-for-profit companies can participate in the WOTC, and only in regards to veteran hiring. Is that correct?
Correct.
All right, we have one more here. Is WOTC the only credit described that 501c organizations can take advantage of?
Yes, but again, like we talked about, only the veteran target groups with the WOTC program. None of the other target groups apply.
All right, thank you. And that looks like it was our last question. Thank you, Kyle and MaryCaitlin, for a great presentation today. If you think of any more questions for our presenters, you may reach out to them directly. Also, if you submit them through the Q&A, we will do our best to follow up with you after the presentation. And as a reminder, if you attended today's presentation in a group and would like to receive CPE credit, you must complete the group attendance sheet found in the slide deck and handouts widget to the right of the slide view. If you participated as an individual and met all certification requirements, your certificate is available to download now in the CPE progress window to the right of the slide view. I'll keep the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have any difficulty downloading it now. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey as your feedback is very important to us. And thank you for joining us, and we hope you'll join us again next time.